When someone asks, how do I get a cheaper insurance policy? The common wisdom is to shop your policy around. The understanding is that some insurance company somewhere is going to want to undercut another company to take your business. You've just got to look around to find them. For years, this wisdom held up for anyone who actually had the diligence to keep up with this annual activity. But for 2025 coming into 2026, we might be running into a new problem, which is what happens when the cheapest policy is still too expensive. Now, as a licensed auto insurance agent, I've got to say that getting the cheapest insurance you can find with no regard for who the company is a terrible idea in the first place. But when premiums jump up 40% in 3 years, you got to do what you got to do. What I think is going to become more popular as policies get more expensive is not shopping your policy, but shopping your coverages. What parts of your auto insurance coverage are you able to change in order to bring down your auto insurance price? And honestly, I think it's about time. A lot of people are driving around with more coverage than they need, and absolutely no one that you interact with from the industry has any financial incentive to tell you otherwise. If you have an agent you have physically met or know personally or have actually talked to before, there's a good chance they've helped you set correct coverages. But with so many policyholders setting their own coverages from their couch, a lot of people probably have some really wrong numbers. Okay, we're going to do this for California because I run a Californian auto insurance agency, but the logic here applies to all states unless you're a no fault state. Okay, so the five coverages for auto insurance are liability, collision, comprehensive, uninsured slash underinsured motorist, and medical payments. And it seems like a lot, but your decisions here are really just based on three questions, which are do you own your own car? Is it a nice car? And do you have a lot of money? All right, so here's how you set your coverages. If you don't own your car outright because you either lease it or you have a loan out on it still, you have to get collision and comprehensive. Collision covers repairs if your car runs into stuff, and comprehensive covers if stuff runs into your car. You'll get the actual cash value of the car if it's totaled in an accident, which will allow you to pay back the auto loan. And if the actual cash value wouldn't cover your auto loan, which sometimes happens on a longer loan or earlier on in the loan, then gap insurance would cover the difference. If you want to know what the actual cash value of your car is, that's pretty hard to tell, and the insurance actually doesn't really tell you until after you total it. But if you just look online and look at the used car market, it's usually that minus 10-ish%. Now, if you own your car, whether you want collision and comprehensive depends on if you have a nice car. If you've got a nice car and you want to still have a nice car if you get in an accident, you've got to get the comprehensive and collision. And I guess it's more accurate that if you have a nice car and you don't want to or can't pay out of pocket for a new one, then you'd want comprehensive and collision. I'm a supporter of everyone should have less nice cars and treat their cars primarily as people movers, but I know that's a minority position in America. And cars should not be a status symbol, and their existence as a status symbol is what's driving up, in part, insurance costs. All right, next, do you have a lot of assets or income? This is going to determine how much liability coverage you're going to get. Liability coverage is what covers you when you cause an accident, and it's what can really ruin yours and, of course, someone else's life. Liability is written in three numbers like this, where the first number is how much a single person that's injured can get paid out. The second number is how much the insurance company will pay out for injuries across an entire accident. And the third number is the maximum the insurance company will pay out in property damage from a single accident. How much liability coverage you get can depend on your goals. For some people, they want enough liability that no one comes after their personal assets, and some people want enough liability that they'll be able to cover any accidents fully that they cause. If you're trying to save money, then most likely you want the minimum amount of liability you can have to protect your assets. And if you have assets of say over 250,000, then you'll want to carry a pretty large amount of liability. Usually 100, 300, 100 is okay. If you have a lot of assets, say over 500,000 or over a million, then you want 250, 500, 250 in an umbrella policy. That liability is what the minimum requirement for an umbrella policy is. And when we're talking about what your net worth is, you want to not include your 401k from that. Your 401k is not included because people, when they see you, cannot come after you for it. There's an unspoken rule kind of going on here, which is that when it comes to accidents, especially right after the collision, There is an understanding that the person you hit might immediately be thinking, how much money does this person look like they have, and how much might I be able to sue them for? It's why nicer cars have higher premiums for the same amount of liability coverage. It's not like you're more likely to be a worse driver because you have a nicer car, but you're much more likely to be sued because you're presumed to have more money, or at least a higher liability max worth going after, or a higher net worth worth going after. Now, if you have less than 250 in assets, you're probably good with 50, 150. And if the price for 50, 150 is too much, then the California minimum of 30, 60, 15, or the minimum in your state, whatever that is probably fine. Each state has a minimum amount of liability that each driver is supposed to carry around to be legally allowed to drive. The idea is that if you cause an accident, you have to be able to at least help pay for the damages you caused. But then comes another kind of interesting unwritten rule of our society, which is that legislators and congresspeople decide that it's okay for people to be able to cause accidents that they can't fully pay for. And if you're on the other side of that accident, that's just too bad. You could be hit, that person could be in legal compliance, and you could get completely shafted with absolutely no legal recourse. Now, from a functioning society perspective, you can see that you can't gatekeep driving a vehicle to only people who can afford maximum liability. So in the 1970s, the powers that be created uninsured slash underinsured motorist coverage. If someone has no or not enough liability coverage, then that coverage kicks in and covers you personally. And no one really describes it this way, but it's a progressive fee on affluent people to cover the cost for those who cannot afford it. Progressive meaning that the more money you have, the more you end up paying. The less money you have, the less you end up paying. But it also has a secondary effect, which is that now people who could afford liability coverage but have little to no assets don't really need to get more than minimum liability coverage, assuming that the other party is supposed to have their own UIM slash UM coverage, uninsured motorist slash uninsured motorist coverage. This, of course, leaves a huge gap, though, for folks who can't afford the UIM slash UM coverage. If they're in a catastrophic accident, they just have to hope that their injuries can be covered with $30,000. And if two uninsured motorists get into a car accident, well, that's just what driving would be like if insurance didn't exist. It'd be absolute mayhem. If the premium for minimum coverage is still too high, pretty much all states force auto insurers to cover people at lower rates if their income is low enough. For California, it's the California Low Cost Automobile Program, or CLCA. The last coverage we haven't talked about yet is medical payments, which covers medical costs regardless of who's at fault. So that includes if you cause the accident. And you might think if you have health insurance, you don't need this medical payments coverage, but we all know health costs in America, even with health insurance, can be a lot between deductibles, copays, and coinsurance. And on top of that, the medical payments coverage covers anyone in the car with you, just in the case that they don't have health insurance and they can't sue you, or if they do sue you, they'll just get whatever is in the medical payments coverage. Okay, so that's all the coverages and a quick top level breakdown of what coverage you should get based on some simple questions. If you're really looking to change coverages in order to get cheaper insurance, or haven't looked at your coverages in a few years and things in your life have changed, then we have a much more in depth coverage quiz that's linked in the description below. If you want to shop your coverage with the insurers that we signed with, we can do that too after the quiz, but that's only for California residents as of now. It really sucks that car insurance is getting so expensive, but we'll continue to do our best to help people. We think that insurance literacy is one of the best ways, and maybe one of the only real lasting ways in the face of stagnant wages and accelerating wealth inequality to keep people ahead of their premiums. We'll keep going for as long as we can, and if you support this idea, then please like the video and subscribe to the channel. Hopefully you learned something useful today, and we'll see you next time.